You know, in every can of paint, every piece of plastic, even in your sunscreen, there's an invisible giant at work. It's an entire industry built on a single brilliant white powder. Today, we're diving deep into the titans who control this market and the brutal storm that really threatened to bring them to their knees.
So let's just start with a simple question. Have you ever wondered what that secret ingredient is that makes your wall paint, well, paint-colored? What makes it opaque? Or what makes your sunscreen work and the plastics in your car so vibrant and durable?
Well, the answer to all of that is titanium dioxide, or TiO2 as it's known in the industry. It is a brilliant white pigment that is a fundamental and, often irreplaceable building block of our entire global economy.
All right, so here's our game plan. First, we're going to uncover the world's whitest secret and really dig into why it matters. Then you'll meet the industry titans and their completely different battle plans. We'll dive headfirst into the 2025 market storm that pushed them to their limits and follow that up with a head-to-head financial showdown. And then finally, we'll reveal the analyst's verdict on who really came out on top.
So why on earth should investors care about a simple white powder? Well, because its demand is an incredibly powerful proxy for global economic health. You see, when the world is building and buying things, it is buying TiO2.
Now, the key to understanding this entire market is one single word on this slide: irreplaceability. I mean it. There is just no cost-effective substitute for TiO2. No other white pigment out there offers this combination of brightness, opacity, and durability. So this isn't just a product, it's practically a monopoly of physics, and that ties its demand directly to the pulse of the global economy.
Okay, so let's meet the main players. In this high-stakes game, three Western giants totally dominate the field. And what's fascinating is that each one of them faced the 2025 storm with a radically different playbook. And in doing so, they really revealed the DNA of their corporate strategies.
Based on how they performed, we can really frame them as three distinct archetypes. First up, you've got Chemours. We'll call them the hedger, because they used a powerful second business as a shield. Then there's Tronox, the fortress, built on the solid ground of controlling its own raw materials. And finally, Kronos, the pure play, basically a nimble ship sailing without a buffer, completely exposed to the market's violent waves.
And this slide right here, wow, it perfectly illustrates the power of Chemours' strategy. I mean, just look at the stark contrast in these margins. While their TiO2 business was getting absolutely hammered, posting just a 6% margin, their refrigerant business was soaring at 32%. This wasn't some side gig, it was a financial seawall, holding back the flood and keeping the entire company afloat.
Now, Tronox's strategy, that's built on one word: control. By owning the entire value chain, we're talking from the mines in Australia and South Africa all the way to the final pigment, they aim to build a fortress against volatile raw material prices. In an industry where your input costs can just destroy your margins, this strategy is designed to make them the lowest cost producer and pretty much the last company standing when a price war breaks out.
And then you've got Kronos, a really stark contrast to the others. It's a pure play, and as you can see, a staggering 90% of its revenue hangs on the fate of TiO2. Now, that kind of focus can be a real strength in good times, but it also means that when the market catches a cold, Kronos gets pneumonia. There's just nowhere else for them to turn.
And the result? Well, you can see it right here. When the market turned south, Kronos had to slam on the emergency brakes. They slashed production down to just 55% capacity in the fourth quarter. Think about that. This wasn't some strategic trim. It was a drastic defensive move just to stop inventories from piling up and to preserve cash, even if it meant sacrificing short-term profit.
Okay, so this brings us to the central conflict of our story, the market storm of 2025. And this wasn't a minor dip, folks. It was a perfect storm of global economic forces, and it slammed into the industry with the force of a hurricane.
It was really a classic chain reaction, like dominoes falling. Central banks all over the world started hiking interest rates to fight inflation. That, in turn, put a chokehold on the housing market because mortgages became way more expensive. And since the biggest end uses for TiO2 are coatings and plastics for construction and renovation, well, demand for the white pigment just fell off a cliff.
The Titans' response was swift, and it was brutal. Production was slashed across the board. But what's even more telling was the shedding of assets. Plants were closed, in Quang Yen, in the Netherlands, in Fuzhou. The entire playbook changed practically overnight. The game was no longer about making a profit. It was about survival. It was about generating enough cash to live to fight another day.
So, how did these strategies actually perform under fire? It's time to look at the hard numbers. Welcome to the financial showdown.
Now, before we dive in, let's just clarify a key term here, EBITDA. I know, the acronym sounds complicated, right? Don't let it fool you. For our purposes, just think of it as the raw cash profit a company generates from its core operations. It basically strips out all the accounting and financing noise, giving us a really clean look at how profitable the actual business is. It's the go-to metric for an apples-to-apples comparison.
This table gives you a sense of the scale we're talking about. Billions in revenue, even in a really tough year. But in 2025, revenue was a vanity metric. The real story, the true test of these strategies, was profitability. How much of that top-line number actually made it to the bottom line as cold, hard cash?
And this brings us to a really crucial insight from the analysts at HDIN Research. At the bottom of a cycle, book profit can be an illusion. What truly matters is the authenticity of cash flow. In simple terms, forget what the accountants say and follow the cash. Is the company generating enough real money to pay its bills and service its debt? That's the only question that matters for survival.
All right, so let's move to the final verdict. Having analyzed the strategies and the financial fallout, what does the future look like for each of these titans? And maybe more importantly for investors, what are the key risks you need to be watching out for?
The analyst's verdict basically flags the unique red flag for each of these titans. For Tronox, it's the mountain of debt that puts their cash flow on a knife's edge. For Chemours, it's a question of trust, and that stems from a history of manipulating financial metrics. And for Kronos, it's an unsustainable survival strategy. You just can't sacrifice profit for liquidity forever without bleeding out.
So, the crucial takeaway is this. Chemours' diversified model proved to be the most resilient shock absorber. Tronox is the high-stakes gambler, leveraging its mining operations to pivot into the strategic rare earths market, a potential game-changer for them. And Kronos remains the most vulnerable, a pure-play ship in a cyclical storm, just lacking the financial ballast of its competitors.
So we'll leave you with this. The 2025 storm was a real-world stress test for three competing philosophies, and it poses a fundamental question for any investor in a cyclical industry. When the storm hits, where does safety truly lie? Is it in diversification, in vertical control, or in pure specialization? As the Titans of White have shown us, there really is no easy answer.
This explainer was based on some really comprehensive analysis from HDIN Research. For further in-depth reporting on industrial markets, you should definitely visit them at hdnresearch.com. Thanks for joining us.